What's going on, YouTube? If you guys are new to the channel, hit the like button and the subscribe for the YouTube algorithm. Guys, we got to push this out to more people to help their portfolios as well, help them be better traders, all that good stuff. So before we get into it, like, subscribe, like I just said, and we got to talk about Neflix stock. It is up 12.5% in after hours. I don't know if you guys know what's going on with Netflix, but I'm going to break it down through an article on CNBC right now for you guys, so stay tuned. Let's get into it. Before we get into the article, guys, I'm going to tell you guys about the strangle I did and why I chose a strangle over a certain direction. As you guys can see, even on the Robinhood don't have the best charts, but you can see a clear resistance line, say about 475, a clear resistance line, and consolidating since pretty much July. It hasn't broke out at all past like 550, 556. So it's had this tight range, and it was stuck on this tight range. There was neither a earnings sell-off or earnings run-up. So what I'm trying to show you guys with this example of the strangle I did is I made sure that I didn't get the Friday contract that's expiring in the next 3 days. I got the one that is another week out because you can play theta more, and this needed to move pretty far to get in the money, and I kept it small at $100 because I think that with Netflix has a high IV, contracts are expensive. So if you get that big move, if you only put $100 on it, odds are if it moves big, 1 year contracts will at least be $100, so you didn't lose anything. But you got your hand in the cookie jar in case you get a wild move. Now, I think I'll be just fine on these trades. I think I'll make profit on these trades. But that's one thing I wanted to point out because a lot of people don't play theta in their advantage. If you don't know what theta is, I made a previous video about options and theta and how to use that in your advantage. So I highly recommend you guys go watch that video. But we are going to get into the article about Netflix earnings. And we're going to start off. It says Netflix reported fourth quarter 2020 earnings Tuesday that beat analyst expectations on revenue and net subscriber additions, but fell below EPS estimates. The company said it is close to being free cash flow positive and will consider returning cash to shareholders through buybacks. Netflix said it would no longer need to raise external financing for its daily operations. And this is the CEO, Reed Hastings, CEO of Netflix. And this goes on to say, Netflix reported earnings for the fourth quarter of 2020 after the bell on Tuesday, announcing it is very close to being free cash flow positive and is considering stock buybacks this year. It expects to be around break even on cash flow. Now, if you guys don't know what stock buybacks are, real quick, I'll explain it. So now, the point to be on the stock market, right, is for companies is to raise capital in expectations that one day they will pay dividends or buy back shares, return capital to investments, return on capital. People investing want a return, right? So two ways they do that is the dividends, which pays out quarterly or annually or semi-annually, and then they'll do share buybacks to decrease the amount of shares that are outstanding, so essentially make yours more valuable. Now, it says the stock is up about 12% after hours. Here are the key numbers. Earnings per share EPS $1.19 versus $1.39 expected, according to the firm that does basically all the EPS numbers, estimates, all that. See, so they did miss by 20 cents on the EPS, the earnings per share, but with all this other stuff, that is seen as minuscule. The people are more concerned about the free cash flow and the share buybacks because they can return capital to investors. But it says revenue was $6.64 billion versus $6.626 billion expected, according to the firm. Global pay net subscribers additions 8.5 million versus 6.47 million expected. Now this is where Netflix stock is going to see a rally from too. This is bigger news, just like the share buybacks. They kind of hit this one out the park by 2.02 million more subscribers than they were expected. That's a lot if you consider each subscriber is paying what, $13.99 or something for Netflix now. They keep raising the price, so they keep bringing in more cash flow. So Netflix subscriber growth in this, basically it was saying, yeah, in the middle of 2020 it was at almost 16 million subscribers, and then a lot of people stopped because everything started going back to normal, and then now fourth quarter 8.5 million subscribers. So that's really good. That's where I expected with such a low subscriber growth last time, that it's like they needed key metrics to hit for the stock to go up, and if they missed, it was going down. It says the service surpassed 200 million paid subscribers for the first time in the fourth quarter. It passed 100 million in 2017. It says Netflix expectations of soon becoming free cash flow positive would bring to life the bull case for the stock. Netflix said it would no longer need to raise external financing for daily operations and would even explore returning cash to shareholders. Netflix hasn't made such a move since 2011, a pivotal year in the company's shift from DVDs to streaming. Netflix CEO Spencer Newman said the consideration of buybacks would not represent a retreat from bold investments. In quotes, "We put a premium on balance sheet flexibility, so we're going to continue to invest aggressively into the growth opportunities that we see, and that's always going to come first," he said. "But beyond that, if we have excess cash, we'll return it to shareholders through a share buyback program." The company said it intends to pay down more of its debt as well. It raised $15 billion in debt since 2011 and currently has $8.2 billion cash on hand. So that is actually very good. That's a lot of cash compared to debt, and that's since 2011. So if you consider that, they've paid down some, and they're in pretty well off shape. Netflix has been free cash flow positive for the past 3 quarters, though executive mostly credited that as an effect of postponing production during the pandemic. Free cash flow for Q4 was negative as predicted due to production restarts in some regions, but not as significant as expected. Free cash flow for the full year 2020 was $1.9 billion versus negative $3.3 billion in 2019. So that is impressive numbers year over year. 2019 to 2020. Now it's a new year, but in Q4, Netflix had to contend with several new competitors in streaming, including Apple TV Plus, Discovery Plus, Disney Plus, HBO Max from AT&T's Warner Brother Media, and Peacock from CNBC parent NBC Universal. Still to come is Viacom, CBS, Paramount Plus. Executives said in their letter to shareholders that 2020 was a testament to the company's approach of improving the platform for subscribers. Satisfaction to stand up to competition. Disney Plus had a massive first year, 87 million paid subscribers, and we recorded the biggest year of paid membership growth in our history, executives wrote. That makes me feel a lot better about Disney. And Disney actually started popping as the earnings was coming out right after the bell. So that was big. So did Apple a little bit, but Disney really popped. It says Netflix executives spoke in depth about competing with Disney, much more so than in previous earnings interviews. Co-CEOs Reed Hastings and Ted Sarandos said that Disney's early access success in streaming shows subscribers are willing to pay more for great content. VP of Investor Relations Spencer Wang noted that about 30% of those 87 million subscribers, however, are from Hotstar, a streaming platform Disney offers in India, which has a lower average revenue per user, ARPU. The company shared details of some of its biggest hits from the quarter, like The Queen's Gambit, which 62 million member households watched in the first 28 days of service. In addition to becoming the biggest limited series in Netflix history, Netflix boasted its cultural impact, prompting chessboard sales. It goes on to say a couple more movies. Netflix said production is back up and running in most regions, so that's going to be big going forward too. They're all about new content and keep evolving. Said it previously announced it would plan to release 1 new original film per week in 2021. So very aggressive. While the executives said theaters are not core to their business, they're eagerly watching changes to the industry status quo, which typically requires films to stay offline during an exclusive showing window. Hastings said he is interested to watch Warner Brothers' experiment of releasing its films both in theaters and on HBO Max in 2021. But he said the full effect of that strategy won't be clear until after the pandemic. So basically, like first I want to say, with like AMC running up and doing all that it's been doing, I do not invest in theaters. I do not believe in the theater industry long term. If you do, I mean, best of luck to you. For the price of 1 movie at a theater, popcorn, candy, drinks, you can subscribe to Disney Plus and all these carriers pretty much combined. For 1 movie, I don't see people doing that too long into the future. So that's my perspective around it. I already have plays in Netflix. I already broke that down in the beginning of the video. So I think that's all I got. That's all you really need to know. I encourage you guys to do your own research and follow up on this video. Hit me in the comments with if you guys are playing Netflix earnings, the continuation run, any of that good stuff. But till next video, I'll see you guys later. Peace out.